This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
One of the most frequently tested disposals in our examination is that of shares. Here in Chapter 13, we see that we're dealing with both shares and securities. Now, securities are very much quicker and easier to deal with. As you'll see here in Note 1.1, we may be dealing with, there's a lovely expression, actually that should say gilt. I think that reads gift there. Let me clarify that. That is gilt-edged securities. How long is that bit in the notes? Gilt-edged, not gift-edged securities. Gilt-edged securities, all government securities as they are known. And qualifying corporate bonds. Qualifying corporate bonds, your typical corporate loan stock, a debenture, an item of that nature. And I said they're quick and easy to deal with because they're exempt. The disposal of these investments will be exempt. You may recall that at the very beginning of Chapter 12, we saw a definition of a chargeable asset. Remember, for a capital gain to arise, there had to be a chargeable disposal for chargeable asset by a chargeable person. Well, a chargeable asset was interestingly defined as all assets except those that are exempt. And we had a list of exempt assets. Not a huge list, and we picked out from that list probably those that are the most important for us in terms of most frequently tested in exams. And there's this is one of those examples. We saw certain types of chattel, of course, and cars as being typically tested examples. This is another one. So if they are securities, whether they are government, i.e. gilt-edged securities, or whether they're corporate loan stock, qualifying corporate bonds, their disposal is exempt. So we've got no calculations to do on those. It's when we have to deal with shares that we have just a little bit of a problem. Inasmuch as throughout Chapter 12 we saw that if in computational terms there was going to be a problem in calculating your basic chargeable gain or allowable loss, it was in determining the cost figure. And so it is now, as we mentioned at the end of our last lecture together, that when dealing with shares, what we'll see is a situation where a taxpayer has acquired shares in a particular company over an extended period of time, multiple purchases. And of course, as these shares will change in value from one day to another, we may have 3 purchases at 3 different costs. There isn't anything for you to do until you see a disposal. We'll be told how many hundreds or thousands of shares in that particular company the taxpayer has sold and what the sales proceeds were for those shares. So we've got the sales proceeds. If they want to tell us about any selling expenses, they will, and we can deduct those expenses from the given sales proceeds. But then we have the problem. What is the cost of the shares being sold? The problem we'll find is that the taxpayer is now selling some, but not all of his or her shares. When we sell some of those shares, shares that were bought at 2 or 3 or more different occasions at different costs, then which shares are we now selling? If you don't know which shares we're selling, then we don't know what the cost of those shares would be. So as you may guess, HMRC do not leave it up to us, the taxpayer, to decide which of the shares we bought at which different costs will now be the ones that we deem to have been sold. There are rules. HMRC provide us with those rules, and that's what we'll see here in Note 1.2. So disposal of shares. As we've already said, when shares are disposed of, a problem arises in computing the allowable cost, as shares in a company may have been acquired, as the note then says, over several acquisitions at different costs at, of course, different points in time, different dates. Therefore, HMRC have deemed that when shares in a company are disposed of, they are matched. These are the important share matching rules that now we look at. They're matched against acquisitions of shares in the company in the following order. Right. Any shares sold today would firstly be matched with any shares acquired today, i.e. on the same day as the sale. So if we buy and sell, buy, whichever way round, on the same day, that sale is firstly matched with that acquisition. Now, it may happen in an exam question, but it's probably unlikely. The first port of call, if we're going to have, again, a thorough test of these rules of identification, these share matching rules, is probably this one. And it may come as an odd one, so far as you're concerned. Because you would think that when you sell shares, they are shares that you already own, that you bought at a previous point in time. So it will appear odd that what we have in this second of our share identification rules is shares acquired within the 30 days following the sale. So shares that we haven't yet bought that we go on to buy within the next 30 days, they will be looked at prior to going back in time, which you would have thought was your obvious first port of call, to look back over those acquisitions that we had had, whether there was 2, 3 or more of them in the past, and somehow or other work out what cost of the shares now being disposed of will be allocated to this particular disposal. But no, if there is that acquisition within the 30 days following the sale, it is those shares that are firstly deemed to be the first part of this sale. And only after those have been accounted for, matching directly the proceeds of those shares with the cost of those shares, would we then go to where the vast majority of taxpayers will go on any share disposal, because they won't have bought on the same day. They won't have bought in the following 30 days. They will have bought at different points in time in the past. And that's where we go to the share pool. So the third port of call, and where most of your work will no doubt lie, is looking at shares that are within the share pool. And the share pool, as we're about to see, will be a very easy exercise. It's a listing exercise. We just list out how many shares were acquired at the different previous acquisition dates and what were the cost figures. And we lump them all into a pool. So that when from a pool, some but not all of the shares are sold, we don't have to worry about the first acquisition, the second, the third, and all of those individual acquisition costs. We have a share pool, and therefore we average out the shares within that pool. What's the total number of shares in the pool at this point of disposal? What is the total cost? And divide that total cost by the number of shares and get an average cost per share. The share pool simply extracts shares from the pool at an average cost of the shares within that pool at the point of disposal. A simple mathematical exercise. Now, the matching rules that we deal with here, remember at the moment we're dealing with still personal tax. We haven't yet moved on to corporate tax. That awaits us just a little bit later. But we did say that we'll be looking at chargeable gains within corporate tax in later chapters once we've had our introduction, that is, to corporation tax. Because companies are charged to corporate tax on both their income and their chargeable gains. And of course, it wouldn't be tax without another silly rule. And what do we have? Well, we have a different matching set of rules here for individuals as compared to those that apply to companies. And that, therefore, immediately sets you, I hope, on a thought that when handling any of these individual objective testing questions, where you are taken question by question from one remote part of the syllabus to another part of the syllabus and to another and to another and to another. So you have got here these questions on lots of different abstract areas. It's not like, as I've said to you before, here, when we do examples, it is immediately off the back of me showing you what to do and having revised or taught you those rules. What you've got to remember in an exam question is, there you go, something that you looked at a day ago, a week ago, 3 days ago, a month ago, whatever, that is now being tested. and you've got to understand and identify what the issue is. So when in an exam question, you are seeing that we are dealing with the disposal of shares, the first thing you look at is who is making the disposal. Anything in terms of capital gains, because inevitably we have different rules for individuals compared to companies, who's doing the selling? That's your first question. Am I dealing with an individual, what we're looking at now, or am I dealing with a company and therefore corporate tax, which is what we'll look at later in the course. So there's your first task. Now we will see a situation here where an individual taxpayer has made a disposal of some, but not all of the shares that they own in a particular company. And that means, therefore, these are the rules that we need to apply. So, we check out whether any shares were acquired on the same day. Probably no. We check out were any shares acquired then in the following 30 days. Very good chance that yes will be the answer to that. And those shares are specifically dealt with. What is the sales proceeds of those shares? What was the cost of those shares? And we can work out a specific gain or loss that arises. There, of course, will be more shares that have been sold than were merely those acquired in the following 30 days. And that means we go to the share pool. It is, as I've suggested, a simple listing exercise. It keeps a record of the following details of all shares acquired in a particular company. Each particular shareholding in every individual company has its own separate share pool. A PLC, B Limited, C PLC, whoever it might be. They all are separate pools. We do not throw all shares in all companies into one pool. No. Every company, every shareholding in a company has its own share pool. And for those shares, we record the number of shares that have been acquired and now at this point of disposal, disposed of. And of course, what was the cost of those shares when acquired. The number of shares will include all acquisitions. Now you might think, I mean, all acquisitions, you go out and you purchase, you buy shares. But actually we might acquire shares in ways other than just purchasing them from an existing shareholder. What there might be is bonus issues that have taken place and or rights issues that have occurred. Now then, these are terms that you should be familiar with, no doubt, from your financial accounting studies. What are they? Well, bonus issues are simply where a company issues free shares on a proportionate basis to its existing shareholders. Now, you're thinking, why would we just issue more shares? Why would we say to our existing shareholders, okay, guys, for every 5 shares you own in the company, you can have 1 more free share. All it is the company is reorganising the capital section of its balance sheet, dare I use such an old-fashioned term there. And that's got nothing to do with us in terms of taxation. All we've got to know how to deal with is how do you include this within your share pool? What do you do? So we may get a bonus issue, which are free shares, and this will be on a proportionate basis. So at the point a bonus issue comes along, like you get 1 share for every 5 shares held, you have your number of shares column. So if you had 50,000 shares already owned within that share pool, and now there's a 1 for 5 bonus issue, 1 for 5 on 50,000, well, that, if my mental arithmetic is correct, 1 for 5 divide 50,000 by 5, and that's another 10,000 shares. It's a bonus issue, so there's no cost. So all you do at that date of the bonus issue is to add in the new shares acquired, however many of them there may be, but with no addition to the cost of shares, because the taxpayer is not buying them, they are being issued free of charge with those shares. Much more interesting in terms of your share pool is a rights issue. And again, a much more likely event. What is now happening is that the company is seeking to raise new share capital And where does it go to, first of all, to raise that new share capital? Well, it's existing shareholders. That's where it goes. And it offers them the ability to buy, again, so many shares for however many shares they currently own at what would be a reduced price as compared to the current market value of those shares. So rights issues where a company seeks to raise new share capital and offers its existing shareholders the right to acquire, again on a proportionate basis. I've got 50,000 shares and a 1-for-5 rights issue is made. If I choose to take up that rights issue, 1-for-5, I've got 50,000, so 1-for-5 will be another 10,000 shares. Only this time, there will be a payment. There will be a price to pay, because what the company is seeking to do is to raise new additional share capital. So on a proportionate basis, additional shares in the company at an advantageous share price. Now again, we don't have to worry about where these numbers come from. They're given in the question. You simply use them. So we may see a very interesting share pool, in as much as we originally bought some shares. That started the whole process off. A year or so later, we bought some more shares, and then we added to that share pool by taking advantage of a rights issue where we chose to take up the rights to the rights issue, or where we have a bonus issue where simply more shares are issued to us. As we'll see, we have separate notes and separate examples dealing with each of those circumstances, so we'll be going through the detail of that very soon. The shares disposed of from the share pool will be deemed disposed of at the average cost of shares held in that pool. So having listed out the acquisitions, outright purchase, bonus issue, rights issue, at the point of disposal, we add up the number of shares within the pool and we add up the total share cost, i.e. to then get an average share cost, so that when the shares are removed from that pool, the shares disposed of from the pool, they are removed from the pool, we'll know how much of that total cost to take to this particular disposal. We've got our proceeds, we've got our cost, we've got our gain, or we have our allowable loss. The share pool is easier to produce for individuals than for companies. There's only two pieces of information we need to have here, that being the number of shares and the cost of those shares. In companies, of course, indexation allowance may be available, and that would apply. The only information recorded is the number of shares and the cost of shares for us. But in corporate tax, there will be an extra column. We will have number of shares, cost of shares, as we'll see in a later lecture, something called an index cost column as well, where we take account of not just the cost, the price paid, but also any indexation allowance, any relief for the effect of inflation as time goes by. But more of that in a later chapter. Okay, before you have a go at example 1, let me take you through an example. So here we go. If you could sort of pause at this point in time and copy down this particular example, I'll just read you through that to make sure that you've interpreted the writing in the right way. So we're told that to begin with, our taxpayer Aston sold 20,000 shares. So there's our sale, 20,000 shares, in a company called Villa Limited here. And there's your total sales proceeds, £160,000 for 20,000 shares in Villa Limited. And that sale took place on the 1st of June 2020. And Aston had purchased the following shares in Villa Limited. Now what we see here is 3 dates in chronological order of the shares that have been purchased in Villa Limited by Aston. And what information do we need to know? The number of shares and the cost of those shares. So it all kicked off on the 20th of June 2013, where Aston bought 20,000 shares at a cost of £80,000. At the 8th of October 18, we added to that shareholding another 10,000 shares at a cost of £70,000. What then happened was we bought on the 22nd of June 2020 a further 4,000 shares at a cost of £30,000. Now, I laboured the date on that particular disposal, the 22nd of June 2020 there. That is because it is, of course, following the date of disposal. That is following the date of disposal. And that, of course, has now disappeared. What happened? Another sad miracle of technology. I think it said on the 1st of June there of 2020. How on earth did I eliminate that? So, that sale date was the 1st of June 2020. We can see there are no acquisitions on the same day, the 1st of June 2020. That was the first identification rule determined. No shares bought on the same day. Second, in the order of our matching rules, our share identification rules, shares acquired in the following 30 days. And there we go, the 22nd of June 2020. So yes, within the following 30 days. How many shares were then bought? 4,000 shares at a cost of £30,000. Well, that 4,000 shares will be deemed to be the first 4,000 out of the total of 20,000 shares sold. That will be the first disposal. We know what its cost is. We simply have to work out if 20,000 shares have been sold for £160,000, what would be the sales proceeds of 4,000 of those shares? A calculation I'll do with you in a moment's time. Once you've then dealt with that part of the disposal, 4,000 out of 20,000, where do we go next? There's only one place to go, the share pool. You would have to construct that share pool, which will look basically like that. Whereby, oh no, it's disappeared. Where's it gone? It will look like that. Okay, at this particular point in time, you may want to pause, because I'm going to have to write all that out again there. But after having dealt with the June 2020 disposal, acquisition, and worked out what was the gain made on the disposal of those shares, that was 4,000 shares, we said. I'm not going to touch this now, lest it all disappears again. That sale was out of 20,000 shares. That leaves 16,000. They must have come from the share pool. We will then need to construct the share pool. I will first have to write out, of course, all the numbers again in this particular example, so that then we can construct that share pool. So if you pause for a moment, you might just be able to wind it back a little bit and copy out the information as was available there before I magically, incredibly lost that information. Get that noted down. I'll rewrite the information here, and then we'll proceed to work through that example. Remember, you've got to know your share identification rules. When you sell shares, were any acquired on the same day, in the following 30 days, or finally within the share pool. Okay, I'll be back with you in a moment. Okay, well, hopefully you got the right dates and numbers resurrected here in relation to this example. So let's see how we attack it. What we've got to do is now, the requirement would be to compute the chargeable gain arising on the disposal of these 20,000 shares in Villa Limited for £160,000 on the 1st of June 2020. As we said, we would identify, first of all, do we have any shares that were acquired on the same day as that sale? No, there weren't. Were there any acquired in the following 30 days? Yes, there was, the 22nd of June. Those, therefore, are the first shares to be deemed to be sold. That's 4,000 shares out of a total of 20,000 shares sold. So that means that there is a further gain calculation to work out on the contents of the share pool. The share pool contains the June 13 and 8th of October 18 acquisitions. And you list them as we see here, literally exactly the same as you see here. Now, of course, if you're doing an objective testing question, as you probably will be in the context of this particular example, likely to be contained within either section A or section B, then you don't need all the detail. All you need for that share pool, though I will go through it with you in a moment, is how many shares were bought, the number, and the cost, and how many of those shares, therefore, are in the share pool at the point of disposal. We can then deal with the disposal from it. So your workings will be a lot simpler than the full pro forma working that I will show you here. Again, your working, which is not seen by the examiner in section A or section B, has to be sufficient and reliable for you to be able to produce the right answer. It's not for presentation purposes. If you do get, of course, these exercises to do in section C, though this is not a likely one for section C, then, of course, you must present in the right way. Hence why we will, in all of the lectures, show you the correct way to present, but you will simplify that in terms of answering any section A or section B questions. And this is, again, either a section A or a section B problem that we're looking at here. Okay, so how, therefore, do we go about now computing that gain? Now, what we said, we look firstly to see whether there are any shares acquired on the same day as the disposal. No, there weren't. So for us, therefore, the first category is shares that were acquired, so acquisitions in the next 30 days, that being the 22nd of June 2020. We had 4,000 shares. So we need to work out again sales proceeds. Now what we know in relation to the sale is that at that date, the 1st of June 20, when the sale took place, 20,000 shares for £160,000. Therefore, acquisitions in the next 30 days, there it is, the 22nd of June 20, that's 4,000 shares out of 20,000 shares sold, times a sale proceeds, and what that figure was, £160,000. Now, I've given you basically their 20,000 shares sold for £160,000, so that's basically £8 per share. So this 4,000 shares, when you take that fraction, is going to come out to, I think, £32,000. We know, of course, what the cost is. It was a single individual figure of cost, £30,000. We deduct as all of those shares have been sold, the full cost, and that leaves us on those shares with a gain of £2,000. So there's the first part of the gain computed on this disposal of 20,000 shares. The first 4,000 of those 20,000 shares sold, as you see in this calculation here, sold at a price of £8 per share, because 20,000 were sold for £160,000. They had that figure of cost there, £30,000. So a gain of 2,000. On now, therefore, to the share pool. We have accounted for 4,000 of 20,000 shares sold. The remaining 16,000 shares out of that 20,000 share sale must therefore have come from the share pool. There's nowhere else it could have come from. And as I said to you, what you literally do is just copy it down from the question. So we had got, again in relation to that question, acquisition dates, 20th of June 13, 8th of October 18. We know how many shares were bought, and we know what the cost of those shares were. So we've got an acquisition, just to abbreviate that. The acquisition was on what date? 20th of June 13. 20th June 2013, I think it was 20,000 shares, £80,000. We then had a further acquisition. Again, you can write purchase, whatever you want to do here. Again, remember, this won't be written at all for the examiner, only for you. All you've got to do is to pick up straight off the question page what the total of these acquisitions were. But that second acquisition, when was it dated? 8th of October 18. So 8th of October 2018. 10,000 shares, £70,000. Right, it's a pool. Do you know how to add numbers together and then divide? I think you do. So 20 plus 10. In the share pool, at the point of disposal, there are 30,000 shares that have cost, conveniently, £150,000. Now, we have a disposal at the 1st of June 2020. Now remember, we had sold 20,000 shares. Of that 20,000, we've already accounted for 4,000. So we're looking for the remaining 16,000 shares. Out of the 30,000 shares, not that we need this information going forward, it's this disposal that we're interested in, but that would leave some 14,000 shares in that share pool. So in terms of that disposal, it's 16,000 shares out of 30,000 shares in there, which have a total cost of £150,000. So 30,000, £150,000 cost, that's £5 a share. We are now deemed to have disposed of 16,000 of those shares, which I think therefore is going to be some £80,000. That will be £80,000 worth of cost. It's an average cost. We've got 30,000 shares in total acquired at a total cost of 150. We sell off 16,000 of them. What's the average cost of those shares? And that gives you £80,000. That would still leave 70,000 in there if you had to go forward and work out a further disposal. So in which case, let's do the calculation of the gain. We need the sales proceeds. We need the cost. We know that we've got the cost from our working, whether it's working 1, working 2, whatever. It is the share pool. So we'd have a reference for that. We now know that that cost figure was £80,000. The sales proceeds, now remember we were selling, this is the remaining 16,000 out of the 20,000 shares that were sold, and that was sold for, what did we sell those shares for? £160,000 as I recall. And on that basis, therefore, 16,000 shares out of 20,000, 160, well, it was £8 a share, so 8 was 80, so I think that's 128. Just check my numbers on that, if you'd be so kind. But that again worked out on an average selling price per share, 128,000 less a cost of 80,000, and that therefore is a further £48,000 worth of gain. Now read the question carefully, of course, as regards what it is asking you to do, but we now know that on the overall sale of some 20,000 shares, it's made up of 2 individually computed gains. The first being of those shares acquired within the following 30 days, where we had a gain of £2,000. The remaining shares came out of the share pool, and as we see there, we have got a gain of 48. So the total gain on the sale of 20,000 shares, some £50,000. That's likely to be the requirement of the question to compute the chargeable gain arising on the disposal of those shares, those 20,000 shares. That now is total gain of £50,000. And hopefully you find that that's one of the given answers there for you to tick the designatory letter next to it. Okay, in which case, Time for you, therefore, to have a go at a little example there. So if you'd be so kind, go back through the notes, then work example 1, and then come back and we'll make sure that there's no problems so far as the calculations were concerned. Okay, let's see how we fared with this one, therefore. What do they want us to do? Calculate Jane's capital gain on the disposal of the shares, and that disposal of the shares was on the 28th of June 2020. Always the first thing you want to identify as regards a capital gains calculation, a capital gains exercise, is what was it sold for? What was sold and at what point? So we were told here in the question, not at the beginning but towards the end, that Jane sold 1,000 shares in ABC Limited on the 28th of June 2020. This is the disposal that we've now got to deal with, and those shares were sold for 25,000. Reading it as an objective testing question, we have now discovered that we're dealing with an individual, Jane, so we're talking CGT, not corporation tax. It's not Jane Limited, it's Jane, an individual. And it's a disposal of the shares. So it's the share identification rules. So what are they for individuals? As you know, shares that are sold are deemed to be, firstly, those acquired on the same day. It is incredibly unlikely that that is to be the case. Followed by shares acquired in the following 30 days, followed by those shares that were acquired within or prior to the disposal, and all of those previous acquisitions will be within the share pool. So what have we got? Jane owned shares in ABC Limited. She acquired 1,500 shares, 31st of May 16, £20,000. Very clearly, prior to the disposal, they will be in the share pool. 500 shares on the 30th of June 17, £10,000. Again, prior to the disposal, they are in the share pool. On the 7th of July 2020, wait a minute, the disposal date was the 28th of June 2020, so this date is following that disposal, so these shares aren't in that share pool. They weren't acquired on the same day, but they were acquired within the following 30 days. So here's our first of the shares to be sold. Jane bought a further 200 shares in ABC Limited for £4,000. So we now know that when Jane sold 1,000 shares, the first 200 of those shares will be deemed to be those that she bought within the following 30 days, i.e. on the 7th of July 2020. Those were the first ones. So that will account for 200 shares out of the 1,000 shares there sold. So the remaining 800 shares must then come from the share pool. What will be the content of the share pool? 2 acquisitions. The first of those dated 31st of May 16 for 1,500 shares, £20,000. Now again, as you read an exam question, you can now see that you need a share pool. You'll have number and you'll have cost. You know what the dates are. You don't care what those dates are, but they were acquired prior to the disposal, so they go in the share pool. We don't need any labels on this, only if it's a Section C question, a written question. Do we need to worry about our presentation and the way that we present our answer within our exam paper? But what do we buy? 1,500 shares for £20,000. Then a further 500 shares at a cost of £10,000, giving us therefore at point of sale 2,000 shares costing £30,000. How many of those will be disposed of? Well, 200 were those acquired in the following 30 days out of 1,000, so it's going to be 800 of these shares that will be sold, and with it we'll take 800 over 2,000, 8/20ths of our cost figure there. We'll work it on an average cost basis. And we do that after having dealt with these first 200 shares. I'm sure by now you've looked at the answer to that, but let's just see what's going on here. We know, as it says there, Matching acquisitions on the same day as sale, there weren't any. There were those shares bought in the following 30 days, 200. That's the first 200 out of 1,000 shares sold for total proceeds of 25,000. That therefore will be £5,000 worth of those sales proceeds. What is the cost? The given figure within the question, that was a cost of 4,000, so we got ourselves a gain of £1,000. That's 200 out of the 1,000 shares sold. We now match the remaining 800 shares with the share pool. As we've just seen, listing out the two acquisitions, total shares acquired in the pool at the date of disposal, 2,000, with a total cost of £30,000, of which 800 shares are now being disposed of. And if we take 800 over 2,000 times, what's the cost in there? £30,000. That will equal our allowable cost, which should be 12,000. Put that into your gains calculation. There's your cost of 12,000 coming from there. Your proceeds, the remaining 800 shares out of the total 1,000 sold, which were sold for 25,000. There's your remaining £20,000 of proceeds. 20 less 12 is £8,000. That gain on top of the £1,000 gain there, your total gains on disposal 9,000. Thank you very much. Job done, as we say. Going back to our notes, as we mentioned earlier on, the next areas we'll deal with, but that'll be in your next session here, your next lecture, will be bonus issues and rights issues. Go back and remind yourself before then of how we deal with our normal content of the share pool, our share identification order rules, and also what was a bonus issue and what was a rights issue and what did we say about that. So we can then quickly and easily deal with these rules and work the relevant examples. Have with you next time the example that we did in class this time, because I'll slightly amend that same example to allow us to have a practice before you then work what will be example 2 and example 3. Okay, I'll see you next time.